Good morning, everybody. My name is Cyril Rognat. I'm heading the market research, and it's a pleasure to have you this morning with us for the latest monthly preview webinar of the year. So as you can see on this slideshow today, we're going to speak about notably France and certain banks. We had, of course, headlines which have been pretty interesting as of late, starting maybe with France and this surprising decision by Moody's. Well, surprising. The timing was kind of surprising, but the decision less so. But this downgrade of France and of course this ongoing negotiation surrounding the formation of this new government of France is still a very big topic for us and for you probably as well. And Adrien Camat, our economist for France and Eurozone, will be the one discussing about this subject. Morning, Adrien.
Good morning, Cyril. Good morning, everyone.
And of course, I was mentioning central banks. We just had the FOMC yesterday evening, ECB last week, and many CBs in general over the past few weeks or even days. Canada, SNB cutting aggressively, ECB less so. The one with whom we'll address this interesting subject will be Benoît Gérard. Good morning, Benoît.
Cyril, hi all.
And we'll be speaking about France and OATs in line with maybe what Adrien will say about European and French macro momentum. We had this nice resilience over the past few days on French OATs. What are our expectations for 2025, given the huge supply we'll have ahead of us in France and in Europe in general? What to make out of it, and what does it mean for OAT bond spreads and for French yields as well? So these are the questions we'll try to address and to answer during this webinar. Let's start right away with you, Adrien, about this European and French macro picture, which has been somewhat worsening. I don't want to be too bleak about what the most recent news flow, but things are definitely going in the wrong direction as of late. Is there any reason to maybe be a bit more optimistic than what the market think at this stage, or should we keep this, let's say, negative bias? What is your view?
Yes, thanks, Cyril. Hi, everyone. I think that's not only my view, that's the view, of course, of the research, the entire research team, economic team. So 24 proved to be a very challenging year for Euro area and for many other countries, and we're sure that 25 will also present yet another set of fresh new challenges. US tariffs, fiscal consolidation, potential escalation into tensions with China, and a lot of political uncertainties. And for example, the outcome of the election in Germany next February, and of course the political path that France will have to face. So I think we are a bit more optimistic than the consensus, and I will elaborate a bit on this thing, because regarding our macroeconomic scenario, we expect a very gradual recovery and a narrowing of the US Euro area GDP growth path gap. That's what you can see on the left-hand chart. Real data recently overperformed business survey, and business survey were more pessimistic than real figures. We get, for example, some kind of broken correlations between PMI surveys and GDP growth. That's what you can see on the right-hand chart, where we developed an internal nowcasting GDP growth model. And in this model, you can see that real data, real GDP figures were higher than what our model expects. So we continue to be a bit more optimistic than our models for the next two quarters. If you are looking of GDP growth by country in Euro area, we expect a slight rebound in Germany in the next 2 years, and I will elaborate a bit on it later. We expect growth to slow down a bit in France. I will elaborate a lot more on it with, of course, huge uncertainties, as this is the topic of the day, and some kind of slowdown in Italy and Spain, but the Spanish economy will remain very solid with one of the highest GDP growth among the G7 countries. However, the risk to our forecast are clearly tilted to the downside, as our baseline scenario is based on two very strong assumptions. First, that explains probably why we are a bit more optimistic than the consensus. First, it's linked to tariffs. We'll talk a bit on a specific slide, but we think the pain will be limited for Europe, or at least more limited than Trump's rhetoric. And our US economist thinks the Trump more extreme promise will only remain rhetoric, at least for Europe. And our second hypothesis, strong hypothesis, is regarding the German recovery. Germany is the most exposed country to tariffs. So if we are more optimistic regarding tariffs, we are more optimistic on Germany. That's just logical. And our German economist and chief economist Europe, Dirk Schmauer, also expects some fiscal easing, especially in 26. As he's cautiously optimistic about progress regarding some changes in the German debt brake, and he also expects some increase, moderate increase in German public investment. So that's why our scenario remains of a low growth in Euro area, but some slight increase and a narrowing of the US Euro area US gap in the coming years. So that's here for baseline macro scenario for Euro area and for the US. Our second most important topic, I think, is our inflation forecast. So I will elaborate on the Euro area scenario. So currently we get inflation close to 2%, but as you all know, service inflation and service prices remains very sticky. So on the left-hand chart, you can see that inflation decreased very sharply towards 2% for both headline and core, but remains around 2 to 2.5, and we expect in the forecasting horizon that inflation will remain, depending, of course, of oil prices and energy prices, close to 2% by the end of 26. But we get some stickiness in the service inflation. That's what you can see on the right-hand chart, with the service inflation that is around 4% in year-on-year terms. This is far above the ECB target and far too high to go below neutral for the ECB. And that's why we expect one ECB rate cut per meeting until the June meeting in 25, and a terminal rate at 2%, that is close to our estimate of the neutral rate. And we think that the ECB will keep a very cautious, gradual meeting by meeting approach in the coming months. And even if we expect a decrease in wages in Euro area and a decrease in service inflation, we continue to think that the bar is still too high at this stage for the ECB to go below the neutral rate. But Benoit will elaborate more on central banks and on the ECB. Third topic regarding Euro area, it's tariffs. Can Europe resist to Trump and to Trump's tariff and to the tariff man? I have two very basic messages. The first one is that if implemented, tariff will dent growth and will hurt quite sharply, especially if there are some retaliatory tariff hike from Europe and from other countries that would pose some outright recession risk. That's my first point. And the second one is that at this stage, but maybe we'll change our mind by next January, we think Trump's at this stage most extreme promises remains rhetoric, and he will not do what he said, at least to some extent. So first, just one figure regarding Regarding tariffs, to remember, a 10% tariff hikes for euro-area. That means in deviation to a baseline scenario of minus 0.5% of GDP after 1 year and minus 1% after 3 to 4 years. And that's what you can see on the left-hand chart. And here, that's very striking. So that's just to say that tariffs matters, tariffs hurt if implemented. But our US economists are a bit more optimistic, and they are deeply convinced that Trump's compass is and will remain financial markets, and markets definitely don't like tariffs. During the Trump 1.0 presidency, you can see on the right table that the day of a very sharp decrease in S&P 50 500 that was linked today linked to tariffs. So we think that for Trump, a good policy is a policy that supports the S&P 500. So for us, this stock market vigilancy will remain key for Trump to his ability to implement some tariffs. Our US economists are also very positive on Scott Bessent, the next Treasury Secretary, a market guy. So that's why we expect an increase in tariffs. That's the small table on the back right of the slides. It's a slight increase in tariffs, especially to China, as the US has a lot of big deficit with China. So tariffs will increase in 25, but also and above all in 26. But for the rest of the world, they expect much more moderate increase. So that's all for the euro area for this month. For this new and old changes. So let's switch to France with just one basic question: will political and fiscal ways deal growth? At least I would say that uncertainty will hurt growth at some point, and that uncertainty would remain at least during the next few months, at least. So first, a quick update regarding politics. So Parliament, Ungovernable France. It was the title of one of my special reports just after the snap election last June, July. So unfortunately, this title remains valid. The next government will remain very fragile, and we think political uncertainty is here to stay until at least a new snap election, and more likely until next presidential elections, as there is no guarantee, for example, that we will have a clear majority after next snap elections. And we continue to think that it's very hard to make some compromises to build a large majority, and that's why we think that François Bayrou will remain on an ejection seat despite huge efforts to make some compromises and to find some common ground between parties. So if you can see on the left-hand chart, that's very hard to build coalition in France and to be above the majority threshold. And on the right-hand chart, you can only see that it's very easy to be dismissed, as you only need the far right and the left, the whole left, to be dismissed, as it was the case for former PM Barnier. So how long can this government last? That's very hard to say. I would say maximum next summer and next snap elections, but I think we have to monitor very closely opinion polls. As for example, we saw a switch in Madame Le Pen's positions after opinion polls turned very negative to the Barnier's government. Maybe one small, very quick word regarding the special bill and the special finance bill and what next. So first, as expected, this special finance bill has been voted. This is something quite unprecedented, as we only have it in 62 and in 79, but a full budget was voted after in early January. So at this stage, this special bill is very short, and it enables the state to collect existing taxes. It enables to borrow from the state and from various social security entities. That's only 2 to 3 pages, and that's something very, very short. And this special bill will remain in effect until the 2025 finance bill and the social security finance bill to be enacted. So our question, of course, is first, when do we have a finance bill. Frankly, I don't know. I hope by the next months and before March, but definitely no guarantee. And second, there is no guarantee that we have a finance cycle for this year. So on the one hand, it could has some problems for some agencies as credits are frozen, but on the other hand, I just remind you that some countries such as Spain didn't have budget for during many years. So at this stage, that's something new for France, but other countries are more used to face this kind of problems. So if we switch to economics and to the economic surveys on the next slides, the GDP growth in France proved to be very resilient in the last few months and years. With on the left-hand chart, you can see that the GDP grew by more than 4% since 2019. That's far better than Germany, which experienced no growth. That's a bit lower than Spain and Italy, but definitely Spain is an outlier. But business surveys, when you are looking at ITSE surveys, Banque de France surveys, or PMIs, that's a surveys made to purchasing directors, you can see that the business climate is deteriorating very quickly. Is very super low in the manufacturing sectors. That's the yellow line of the right-hand chart, but also in the service sector. But service sector remain more solid than others. Regarding industry, I just mentioned that few sectors remain very bullish. For example, transport equipment with Airbus, especially, and our transport expert Valentin Maury, for example, expects some improvement in the supply chain, despite some difficulties here to stay. So that's definitely an upside risk for France. I don't have many upside risks to mention, so when I've got one, I share it with you. So of course, regarding manufacturing, there are big difficulties in the car industry, but for example, the transport equipment and Airbus exports remain very dynamic. So all in all, when we are back to global macro figures, we expect GDP growth to slow down from 1.1% this year to 0.9% next year in 2025. That's on the next slide. So 0.9, it was a forecast made 1 month ago, so before the dismissing of the government. So on the one hand, we will probably have less fiscal consolidation than expected. We expected 5.4. We will probably have something around 5.5 to 6%. It's very hard to say at this stage, but we are relatively optimistic that some credit freeze can help the deficit not to be too wide. And on the other hand, the uncertainty shock will be higher than what we had 1 month ago, and it will dent very sharply private investment. So all in all, we will probably revise downwards our GDP forecast for the next financial forecast. But it will depend on the Q4. For Q4, we expect slight negative growth, minus 0.1. Because underlying growth is weak, and also because we will have some counter effect of Olympic effect that support growth in Q3, but it will dampen growth in Q4. So that's why we expect a slight negative growth in Q4. If we are turning to our scenario and the engine of the GDP growth in 25, we expect that's on the next slide, that the private consumption will become again the engine, the main engine of the French economy. So why? For 3 reasons. First, you can see it on the left-hand chart. That's because purchasing power is very dynamic, and France experience a very strong purchasing power, much more higher than private consumption. But in the long-term period, we expect both to be very close. That's the left-hand chart. So we have a very high savings rate, more than 3.5 percentage points above its average level. So we expect it not to go back to its pre-crisis level, but at least to decrease somewhat, for 0.5% or something like that. And the third reason is that inflation will fall very sharply, especially in the first semester of 25, notably due to the fall in electricity prices by 14% by February 25. So we expect inflation to be around 1%. 1%, super low inflation in the first semester, before some pickup in the second semester due to base effect in energy and due to some Olympic effects. So consumption probably the main engine of GDP growth next year. So if we turn to public finances, as we got a lot of questions on this topic, and I think it can be a matter of interest for you, we did with Bastien here, our economic modeler, some simulations regarding the depth, the sustainability analysis of French. So we built 3 scenarios. That was 1 month and a half ago, so some things change very quickly. So one very optimistic, not to say unrealistic scenario based on the initial draft budget law, that's the blue line. One realistic scenario, but currently it's a bit too optimistic, as it will be very hard to reduce our deficit to 3% or our primary deficit to minus 1% by 2029. And a pessimistic one, but currently that's more a reasonable one, in which France does no effort to reduce its deficit, so that the deficit close to 5% for a long period of time. And the very basic message that we have to give you is that whatever the hypothesis, first, French public debt will be on an upward trend until at least 2029. That's what you can see on the right-hand chart. If the government wants to stabilize public debt, it will have to consolidate and to bring the deficit back to 3% by 2029. So that remains very challenging when we are with deficit at 6% of GDP. And 3, if we are on the pessimistic scenario, that means no effort, no consolidation efforts, but the public debt will grow by at least 15 percentage point and reach 130%, that's close to Italian levels by 2030. So that's something you have to keep in mind when you are thinking about France for the next couple of years. So just to conclude, I think I have a lot of bad news, of course, to share, unfortunately, but I still want to remain a bit optimistic regarding France, despite political and fiscal headwinds. First, and I think that's very important, and Benoit we will elaborate much more on it, a lot of bad news regarding France are already priced in. So that's for me, that's a key point. And Cyril mentioned Moody's downgrade, surprising timing downgrade by Moody's. But when you are looking at some correlation between the spread, the attribute spreads, and the level of ratings on the right-hand chart, France is already downgraded by 1 to 2 notches. So a lot, or maybe too much bad news is already priced in. So that's my first point to be at least cautiously optimistic. The second one, as I mentioned, is that other countries have learned to live with a budget. Belgium, Spain, etc. Germany will also face some snap elections in the next end of February, and Belgium has no government since last snap elections, since last elections that takes place in June. Regarding structural strengths, we remain one of the most large and diversified economy. I repeated it very often, but quite often, but I think that's a very key point. And our demographics is not too bad regarding to our neighbors. I just like to give the Italian example. Italy could lose more than 20% of its population by 2070, so less than 50 million versus 60 currently, while France will remain above around 65 to 70 millions. And last but not least, we can expect some positive surprise regarding first private consumption, recovery in some export market shares. We got very bad agricultural exports in the last 2 years. So it can change. Same for Airbus exports, as I mentioned earlier. And last but not least, for tourism, our 2 last year were very not too good and not too bad, but we expect that after the Olympics we can have a very positive tourism year in 25 and in 26. So France is definitely not the new Greece. Benoit will tell you a word on it, and I switch to I finish here, and Benoit. That's your turn. Yeah, last word, quote attributed to Charles de Gaulle regarding cheeses. That's, of course, that's hard to govern France, but don't be surprised. We get a lot of cheese, a lot of different sensibilities. So of course, that's always complicated to govern such countries. That's nothing new. Thanks a lot.
Benoit, just In the meantime,
Yes, sure.
before you start, I remind you that you can ask some questions using the Q&A button of your Teams application. Benoit, CBs and OATs, what's your take on the most recent monetary policy councils, notably ECB and Fed?
Thank you, Cyril. Yeah, sure. This was the last two decisions. The last one for 2024. What's interesting is what's going on in 2025. But let's brush a bit on the decision from the ECB first. The ECB delivered a message that was broadly in line with what the market expected, at least in terms of the policy rate. 25 basis point drop in policy rates. And the ECB is maintaining its data-dependent meeting-by-meeting approach. So overall, it was a broadly neutral message. Neutral for two reasons. First one, because it was well priced by the market. I already said a word about it. And there were elements for both the hawks and the dove. For the hawks, the ECB is indeed not giving much further guidance about what it's going to do in 2025. That's an element of prudence that the ECB was willing to signal to the market, and that's an element in favor of the hawks, saying that fight on inflation is not a done deal. There were elements for the doves, because Christine Lagarde mentioned, and the forecasts mentioned explicitly the downside risk on the cycle and the activity, and it's somewhat validating the market pricing going forward, the OIS curve, because the pricing of the market is going below our own estimate of the neutral rate, which is 2%, and the market expect the ECB to turn. If we think 2% is the real neutral rate in the economy, the ECB expect the ECB to turn a bit on the accommodative side to keep the inflation in check going into 2025. So that's two messages that you had to keep in mind to have the whole set of the elements in the decision. There was another element in the decision which was not actually a decision. It was just going into 2025. The ECB is turning the page of its COVID era, because TLTROs 3 were reimbursed at the end of December. And second, the PPP is not reinvested anymore in 2025. So the ECB is disappearing from the bond market, and he has some implications with regard to supply in 2025, which is expected to be somewhat heavy for EGBs for various reasons, and deficits in France is one of them. So ECB is disappearing from the bond market, and it's important because the PPP, which was the last remaining active or semi-active program, was used to have some flexibility at times, and this flexibility is not in the market anymore. So if the ECB comes back to the market before the implementation of the structural portfolio, so at the end of the QT in 2 or 3 years' time, this is really bad news, because either we have a risk of deflation, so with new QE, or it's because there's disorderly moves in the spread market, and you have the TPI. So if you hear something about the ECB going into the market, again, it's definitely bad news. This is not a baseline scenario, of course, but this is something to keep in mind. The neutral decision is maybe not really a really good news, because it means that there's a risk of stagflation, and this risk is increasing with quite an uncertain effect on rates. It's not a bad case for us, but it's not the case for the market also. And that's what you see on this slide. You look at the left-hand chart, and you look at the OIS, what's priced by the market. And as I said previously, the market expects this to go below 2% in the end of this year. So compared with our own scenario, there's a slight divergence. So once is not a trend, but our scenario is more hawkish than the one from the market, because we stop at 2%, where the market thinks the ECB is going to slide a bit lower than 2%. Why there's divergence? Well, there are two explanations. The first one is that our outlook on business cycle is less pessimistic than what is suggested by the PMI and the micro newspaper, which is really negative. Surveys tend to be more pessimists on the future than the actual outcome. That's one element. And for now, this is a downside risk. So we share the view from the ECB. So it's a downside risk. It's not our baseline scenario. The second reason is related to our outlook on inflation. And inflation, like in the United States, we'll talk about it when it comes to the Fed. We don't do any more significant progress in inflation. And for a central bank whose mandate is uniquely fight against inflation, which is not the case for the Fed, you have to take into account the fact that if the job is not done on inflation, you can do much more to help the business cycle. So sufficient confidence that the ECB, the inflation is going back to target is a prerequisite to do more on the rate side. Because wages remain a concern. That's a real driver of domestic inflation. And the last point of the new set of forecasts, 2027, shows headline inflation above 2%, at 2.1%. Nobody's really able to forecast inflation with such precision so far in the future. So it's more a political message sent to the market that you should not expect too much from us as long as we don't consider the job is done on inflation again. And there's a final reason which is related to the consensus in the Governing Council. And the consensus around what should be done is not so clear. We have some members that deem to be in the hawkish camp, which are, they said it publicly, they are happy with 4 additional rate cuts in 2025. So broadly our scenario, like Wunsch, the Belgium governor. Some that you might think are dove just because they come from Bank of Spain, this is the case for Escriva, are showing some slight hawkish disagreement with Christine Lagarde on the inflation outlook. That's the second uncertainty. And then you have someone like Isabelle Schnabel, which is a fair representative of the hawkish camp, which is keen to display a wide range of estimates on the neutral rate between 1.5% and 3%. So this is a wide estimate. Maybe to signal that maybe the neutral rate is not at this stage, is not a useful tool to implement policy at this stage of the policy cycle. So there's not much clarity. So a lot of scenarios are possible. The one in the market is not ours, and that's the reason why we stick with our scenario for the ECB. What are the risks to our scenario and to the market pricing? Well, the big question for 2025, of course, for the ECB is whether the ECB is succeeding in achieving a soft landing for the Eurozone economy, or if as the market is thinking, will the ECB have to go to a more dovish posture, a more dovish stance going to 24 because of the business cycle? The market seems to think, and we tend to agree on that the Phillips curve is still valid. So the slowdown in the business cycle will help anchor inflation expectations, moderate wages demand from workers, and bring domestic inflation, which is fueled by wages, back to target in 2025 and 2026. When you look at where the market is thinking about the situation, well, when we look at the 5-year inflation swap, which is not so much of a forecast, but a vote of confidence around the ECB being able to tackle its mandate. Well, we saw that briefly. This 5-year has dropped below the 2%. That's a new since the beginning of the hiking cycle and the easing cycle. So that's an element you have to follow. Sure, there was other drivers in the 5-year, which is the price of energy and the and you have the comparison with the Brent prices. Is Brent helping in 2025 the anchoring of inflation expectations? The arguments for it, a new energy crisis, arguments against it, maybe with a heavy supply of in the oil market from the US, for example. That's what Trump advocated for. Maybe it's going to validate a bit more the pricing of the ECB, having to re-anchor inflation expectations. But that's again not our scenario. That's just a risk to this pricing. When it comes to the Fed, we talked about Trump. Time to talk about the Fed. Again, a decision that was what was expected was the cut, the 25 basis point cut, widely expected. However, when you look at the market reaction, you can assume there was some surprise in what happened, and the surprise comes from the outlook, because the FOMC signaled that the pace will be much more gradual than what the market thought previously. I just put for reference on the left-hand chart of the pricing for the Fed going forward at the time of the last projections in September, and the pricing just after the decision. It looks like we are in two different worlds, just with 3 months in difference. And indeed, the Fed is going to is signaling that the end of the normalization cycle is pushed back 2 years later than what was previously anticipated, just 3 months from now. So the easing will be much more gradual. I think that's the main message. And why this surprise? Again, this is the outlook. The Fed is acknowledging that, a bit like in the Eurozone, to be honest, there's no more progress in inflation, and it's even slightly going up when you look at the core PCE, which is the index the Fed looks like to assess the underlying dynamics around inflation, and it's going a bit up, and the uncertainty around the outlook is increasing, and it empirically used to signal that there's a risk of an upside on the inflation outlook. So this balance of risk has shifted, and so the Fed is shifting also its software guidance. This is the dot plots that the FOMC provides to the market to give the software guidance of where the FOMC sees the policy rate moving in the next years. So this is overall a hawkish cut, rather hawkish cuts. The FOMC delivered, and that signals that maybe there's a pause as soon as in January, because the FOMC signals only 2 cuts in 2025. So the market is only pricing 1 chance out of 2 for the next cut in May 2025. So the market is basically saying that the Fed is not doing anything in the first semester of 2025. So it has some consequences on the level of rates. It has consequences on the steepening potential, especially on the very long end of the US curve. Maybe a quick word on the technicals, a technical decision, but not so technical actually, on the balance sheet policy, because the Fed is approaching to the end of its QT process, normalization of its balance sheet policy, and it's fine-tuning the parameters of the balance sheet to anticipate and tame unwarranted effects of this end of QT, with cutting the rates offered on its overnight reverse repo operation of 5 basis points to ensure that there's enough and sufficient liquidity in the money markets to ensure a smooth transmission of the next phases of the policy, because this liquidity, which is stored on the Fed's balance sheet, is not available for other market participants. That's a way to entice money market funds that are using this facility to go into the money markets. That's definitely positive for the Treasury bill supply. We expect for next year that the Treasury will emit a lot of US Treasuries, but the distribution of the split between Treasury bills and coupons will still be skewed toward the bills, and this is another argument to say to the money market funds, go and park your cash in Treasury bills and not at the Fed. So you should not maybe do a confusion around the term hawkish. Hawkish, yes, because the inflation is not making any progress anymore, but there's also an argument based on the strengths of the US economy. So the Fed is signaling less rate cut because the Fed thinks that the US economy is in good shape. And that's what you see in the unemployment rate that is stick to 4.3% for the next 3 years. So the risk on the labor market, that was a big driver of the volatility of the short end of the US curve, because the Fed and the whole market thought that with some horrendous print on the NFPs and the unemployment rates in summer 2024, the Fed had to cut very aggressively and very quickly. And in the end, there's again a change, a shift in the communication from the Fed. Well, maybe there's not much risk on the labor markets. At least that risk has disappeared. It has some impact because the market has understood that this is a monetary policy shock, the last decision, and it's when you look at what the reaction from the rates markets is the real rates that took the brunt of the shock. So it signals that this is a monetary policy shock, and it has, of course, an impact on risky assets, and that's what you see on the left-hand chart. Consecutive to the rise in the real rates, you have a sharp drop of the S&P. But this is short-term shock, because again, when you look at the inflation swap, the market think that's the right-hand chart. The market think that the inflationary outlook, the long-term inflationary outlook for the US, is not affected. And it's interesting to note that the Fed forecast, the new set of forecasts, is taking into account some elements of what could happen with a Trump 2.0 administration. So even though we have a new administration, the markets think that nothing's going to happen in the long term on the inflation front. That was a scare we could have. What are the implications of this decision for the rates market going forward in 2025? Well, it means that the US rates are going to remain relatively high compared to the other G10 curves, and that's definitely an attractive feature of the US curve. And this is good for the dollar, of course, and negative for other currencies. So the level of the absolute level of US rates and compared to the dividend yield, for example, on equity markets, will be a key element of the positioning of portfolios in 2025. It could be a very good year for flows going into US Treasuries in 2025. So just to summarize this central bank session, the ECB and the Fed are going into 2025 in a very different situation, because if for the ECB the range of scenarios goes from soft landing to maybe having to turn more dovish because of the business cycle, for the Fed it's totally different situation, because you could have a soft landing or you could have a no landing at all. That's a real difference that will matter for rates markets and currency markets, macro markets in 2025. Maybe we can switch to the OAT, because that's also the topic of the day. A quick focus on OATs. Just to repeat the main message from Adrien. A lot has been priced already, and when you look at the evolution of the OAT Bund spread since the snap elections in June, not much has happened in terms of the absolute level. Most of the work has been done after the results, and then the spread is going into a range, quite a wide range between 70, 75, and close to 80, 85. So a lot has been priced and barely any reaction after Moody's downgrade, even though this downgrade was unexpected in terms of the timing, not really the move, but the timing. Now there's one question that remains. Is it just Moody's not complacent to France anymore, or is the difference in perception between Moody's on one hand and the other two other rating agencies will remain the same? And does it signal that maybe the move from Moody's is going to trigger an earlier reaction from S&P and Fitch? Well, I don't know, but I suggest we take a look at the derivative markets, because the spread, the level of the spread, is just an average of a lot of scenarios, and the derivatives markets offer a different perspective on what could happen. When you look at the left-hand chart, we looked at the options market trading on the OAT and the Bund futures. And what's interesting is that there's a break in the relationship between the skew. The skew is the difference between call options and put options trading on the same futures for the same maturity. So that's 1 month skew. If the call options are richer than the put options, it means that investors want to get exposed or to hedge against an appreciation, an increase in the price of the futures, so a drop in the prices. And that's what you see since June. The level of the skew is positive for the Bund. So investors expect that there's a skew in the distribution of risk in favor of a drop in German rates, and that's a symmetric with the skew we observe on the OAT. So it signals that there's an asymmetry in the risk on the in the OAT Bund spread. It signals that the market, even though the level of the spread is stable, investors are concerned, more concerned at some point than others, is concerned that there's a new drift or a slippage in the OAT Bund spread at very short on the very short time frame. And this is easily explained by the situation, the political situation, and this political situation is well captured in a small model we like to present. This is the residual of a model when we try to regress to explain the level of the OAT Bund spread with some common factors affecting all spreads in the GB space, the monetary policy with the OIS 1 year and 1 year, or the risk appetite for credit in the Eurozone. And you see that this residual, so what was left unexplained after taking out those common factors that are shared with the OAT and the BTP and Spanish curve, etc., was between -10 and 10%, and on average it was 0. Since the election, it's higher, it's positive, and it's closer to 40 basis points. Sorry. So there's a huge component of specific risk, France-specific risk in the OAT Bund spread. And another derivative market help us to shed light on the situation is the CDS markets. Again, before June and the snap election in June, the CDS, the French CDS, was broadly stable around 25 basis points, and the OAT Bund spread was living its own little life. And since the election, much of what happens in the OAT Bund spread can be related to a credit risk pricing. And that's what you see in the CS market since June, and that's very enlightening, at least from my perspective. And there's a second element when you look at the CS market. Actually, you have two CDS trading on the OATs, and one of these CDS is adding a new credit risk that could trigger the CDS compared to the other, which is the redenomination risk, the risk that France is repaying its debt in another currency than the issuance currency, so the euro. So it looks like the difference between the two is capturing this specific element, and that's what you see on the left hand, on the right hand chart. Sorry, that's the green line, showing there's a slight drift. So there's an increasing risk that there could be some concern around France. So not a concern around France repaying its debt in franc. It's just signaling that maybe the situation in France is taken seriously, more and more seriously by investors, in the sense that it puts France in increasing trouble to cope with the fiscal rules in the Eurozone, in the European Union, sorry. And that's interesting. It's a situation that's specific to France, because when you look at the same CDS basis on the Italian curve, the BTP curve, that's the green line. Actually, it's back to levels seen in May. So there's a signal that the CS market is sending to us, is that on the credit risk of France, there's this specific risk that France maybe will have some trouble in the future just complying with the stability plans that just sent this year, and Italy is not. And that's and Italy share the same EDP, excessive deficit procedure, so that's interesting. But again, like Adrien, I would not like to leave you with a very negative note on France. there's still some attractive features to France, and that's why actually the level of the spread is not moving that much, even though the situation is maybe on a negative trend. And investors are happy to take on additional French debt. That's good news for 2025. That's why our target for OAT bond in 2025 are not slipping higher. That's what we see on the primary markets when the Treasury sells some fresh debt to investors. You look at the bid to cover ratios, for example, on the 5-year and 10-year points. They're close to and higher actually than historical averages. That's a very good sign that you have secondary markets and you have the primary markets where fresh duration is sold to investors. Investors are happy to take it. That's good news and a very good for going into 2025. And then you have all the other features that the OAT curve is displaying compared to other issuers in the EGB space. We took the liberty of comparing OATs with GGBs because there was some headlines a bit catchy saying that Greece was trading through France, and that's it was a pretty bad message. Well, there are a few metrics we outlined in a recent note relating the level traded on the OAT. It's 20 billion a day daily average compared to barely 75 million on GGBs. The use of the OAT is in the repo market. That's 75 billion traded each day. So where you can raise some cash, bringing some waiting collateral. Nothing of that sort is possible in the GGB, where there's no repo market basically. When you look at the regulatory treatment of OATs, when you try to get some refinancing through the ECB, you suffer some haircut. That's barely 4% on the 10-year point OAT. That's closer to 14% for the GGBs. Well, all these features make the OAT a very different animal than the GGBs. So there's a bit of positive tone in all that. Well, the spread is reflecting some concern from the investors, but investors are still happy to take some OATs, and that's why we expect the OAT to remain maybe not the most attractive point an investment for 2025, but at least you have some interesting attractive entry levels actually, and combined with these attractive features, technical features, I think OAT is still worth looking into in 2025.
Thank you very much, Benoit. Just as can you remind us what is your scenario and the research scenario for the 10-year OAT bonds for the, let's say, the next couple of months ahead?
Yeah, sure. Scenario for the months ahead and going to 2025, and given all the caveats, the situations we know, it's between 70 and 85 basis points going into 2025.
So we are not expecting the 10-year OAT bond trading closer to 100 BPs, which is once again a scenario in which we would need some additional stress.
Yes.
The potential stress being it's a remote as we speak, but being potentially a resignation of President Macron.
Definitely.
Thank you, Benoit. We have 5 minutes to take maybe some questions. We had some during the earlier session, and maybe I would be the icebreaker with you guys. Maybe to you, Adrien, there's a question mark surrounding, in fact, the French rating. And we had a question about the timing on which France could be, on average, downgraded to A+. We know that it matters for many investors. What could be the potential deadline? Is it a more question of 2025, or in your baseline scenario, is it for 2026?
Yes, excellent question, Cyril. First, first we have to say that there are a lot of uncertainties. So of course it will depend first of political stability or instability. We get 4 prime minister in 24. I hope that we won't have more prime minister in 25, but that's definitely not sure. So political stability or instability is a key point for ratings agencies. So I think political developments will matter a lot for ratings agency. And second, of course, it will depend on the budget. Will we have a budget or not? What budget? At what time? So of course, it will matter a lot for ratings agencies. So we have a baseline scenario. And we think that Fitch can downgrade France by the end of 25, as we are on negative outlook. And usually the rating agency has 1 year to decide before downgrading the country or not. And for the other agencies, we expect more negative outlook in 25 and a downgrade in 26. But that's, of course, a baseline. Risks are clearly tilted to earlier downgrade. As soon as 25, but that's not our baseline scenario. And just to remind what Benoit said, a lot of things are already priced in the spreads.
Mm-hmm. And so something I think important to say as well is that people are now focusing on spreads between France and Germany, but if we look at the evolution of yields, French yields, so the yields of our OATs, if you look at the 10-year notably yields in France, we're still trading at 3.1%, and 3.1% was the level we had before the dissolution of the assembly, the level we had in April. So while we had this very strong widening of spreads, be it against swaps or against Germany, the good news is that thanks to the ECB, notably, yields, French yields, and cost of funding of the French Treasury has been decreasing this year. It will be 10 to 15 basis points lower than the one we had last year, which was around, I think, for ATs around 3 or 5. This year is very likely we'll have something closer to 295, 290. So there's no big danger. And speaking about bond allocation, all in all, we'll start the year with govies in general, and notably French OATs being very, very cheap against peripherals, of course, if you focus on sovereigns, but very cheap against covered bonds, against supranationals, against credit. So very likely investors will focus a bit more on govies in the early stage of next year, even though, of course, we'll have this massive supply Benoit mentioned earlier today. Do we have a question? No. And it's nearly time to end this call, so we'll probably stop right here. Thanks to you, Benoit and Adrien, for being here today for the last monthly preview of the year. Yeah, well, it's been a pleasure, of course, not only to have my colleagues, but to have you, their listeners, during the course of this year. It's been very interesting, and I'm pretty sure that 2025 will be as interesting, as crazy as 2024 has been. We'll do our best next year to offer you the same kind of webinars and to follow at best, in fact, the most interesting topics, be it on the macro or on the financial side. Enjoy your Christmas holidays and speak to you very soon, early next year. Merci beaucoup et bonne fête, like we say in French. Thank you, guys.
Thank you, Cyril.
Bye-bye.
Thank
Bye all.
you.